Later today, the Fed will cut rates. The big question, is this normalization a bullish signal for Bitcoin? Or is it a recession cut, the bearish trap most traders miss? Today, the Federal Reserve will cut rates. For Bitcoin traders, that headline isn't enough. Rate cuts can mean two very different things. Normalization, a bullish context where liquidity expands, or recession, a bearish context where cuts come too late and risk assets struggle, including Bitcoin. So in today's video, we are going to study 4 macro signals that I watch, compare 2 base cases for Bitcoin and the S&P 500, and forecast what today's cut most likely means for the market. Welcome to Bitcoin Predator, like and subscribe. So as we know, when it comes to rate cuts, not necessarily every cut is bullish. Context is everything. And this spreadsheet right here is going to be our base case, our starting point, in order to have an idea of how the market is going to react and what is the context that we are currently in. So there are 3 types of cuts that we can consider. The first one is a normalization cut, in which economic growth and liquidity is given into the market. The second cut is panic cut, usually when we have a global impact situation, such as big wars or the most recent, the COVID-19 pandemic. And the third type of cut is a recession cut, in which the economy and the labor market in general has already suffered, and now the Fed is trying to catch up in order to make the economy grow again. And each type of cut impacts the economy differently. Now, when you stop to think in our current situation, we can already eliminate a panic type of cut. We are not in a pandemic and there is nothing happening on a global scale, at least at this moment. So we can take the panic cut type out of the way, which leave us with a normalization or recession cut. So we are going to study each type of context so we can have an idea of what the market behaved in the past, first and foremost in a normalization cut. The context of a normalization cut is generally bullish. And this is how Bitcoin price reacted previously. In 2024, we had the first cut by the Federal Reserve. Now, it is important to read the statement because not only the cut itself, but also the statement is quite important because that defines the tone at which the Fed decided to cut the rates. So, for example, recent indicators suggest the economic activity has continued to expand at a solid pace. Job gains have slowed. Unemployment rate moved up but remains low. Inflation has made further progress towards the committee 2% objective but remains somewhat elevated. If you see right here, right on the spot, in the first paragraph, the Fed is explaining what is the current situation of their dual mandate. Keep economic growth while at the same time keeping a strong labor market and the inflation under control. So, as you can see right here in the third paragraph, in light of the progress of inflation, as you know, the job of the Fed is to keep inflation under control and the balance of risks, which is the labor market and GDP. The committee decided to lower the target range for the federal fund rates by half percentage point to 4.34 to 5%. So as you can see here, the Fed is confident that the inflation is moving sustainably toward 2%. As you know, at that time, inflation was not below 2%, but by the tone of that writing of their statement, you can see that the inflation was under control. But they were worried about the unemployment rate, which made them a big driver to cut the rates. This is how a normalization cut is described. And if you see how Bitcoin behaved last year when the Fed decided to cut rates, we can see right here that it was quite bullish since the beginning. And September on 2024 closed on a positive manner. And it seems like that same pattern is repeating this year. So let's see how it goes. That was a normalization cut. Now, let's take a look at how a recession cut sounds like. So that was on September 18, 2007. What happened in 2007? That was the Great Recession in the US. And how was the FOMC statement? The Federal Open Market Committee decided today to lower its target rate for the federal funds rate 50 basis points to 4.34%. Economic growth was moderate during the first half of the year, but the tightening of credit conditions has the potential to intensify the housing correction and restrain economic growth more generally. Today's actions intended to help forestall some of the adverse effects on the broader economy that might otherwise arise from the disruptions in financial markets and to promote moderate growth over time. As you can see right here, a recession cut means that the shit has already hit the fan. So, from my understanding, recession means pretty much a correction. And how the S&P 500 reacted during this time, it was completely bearish. Maybe it was a little bit of a pump at the beginning, but then during the rest of the 2008 year and so on, we head into a bear market. Now we also had the 2001 recession cut, which was pretty much the dot-com bubble. The Federal Open Market Committee decided today to lower its target for the federal fund rates by 50 basis points to 6%. In a related action, the Board of Governors approved a 25 basis point decrease in a discount rate to 5.34%, the level requested by 7 reserve banks, so on and so forth. These actions were taken in light of the further weakening of sales and production, and in the context of lower consumer confidence, tight conditions in some segments of financial markets, and high energy prices sapping household and business purchasing power. Inflation pressures remain contained. Nonetheless, to date, there is little evidence to suggest that long-term advances in technology and associated gains in productivity are abating. So again, the tone is a correction. Sales and production were already weakened. Lower consumer confidence means lower economic growth at the time. And how the market reacted. It was already in the downturn, as you can see right here, and continued to go down even further. So this is what we have on a recession cut, and pretty much in a summary table, if we can see right here, this is what we have. The rate cut size, which is also important. If you take a look right here from the previous cuts, usually normalization cuts, they are 25 basis point. Yeah, we have a 50% basis point in 1989, but usually most of it from all the others is a 25 basis point cut. However, in a recession, usually it is a 50% basis point cut. So the size of the cut also matters. So the first indication that I'm gonna pay attention to later today is how much the size of the cut. If it's a 25 basis point, it usually means normalization. 50 basis point, more likely a recession. The second data that we're going to pay attention is the labor market. Under normalization, it is softening, but not collapse. In a recession, we had sharp jump in unemployment. Second data is going to be the inflation outlook. Under normalization, it is cooling, though above 2% goal, but recession, it is rapid disinflation or deflation. Fed messaging, just like we just read on the statements, the tone. On the normalization, it is cautious, data-dependent normalization. Under recession is a crisis response. Historical context. It is going to be similar to past normalization episodes. But under recession is going to be similar to 2008-2001 cuts. Now, let's take a look at each of those features, starting with the data that I believe that is going to be the most important signals that we are going to look and how much likely we're going to get a bullish or a bearish cut. The signal number one is going to be the true rate of inflation. And as of right now, the true rate of inflation sits around 1.56%. I talked about this data on my previous video that you can find in the comments, and ideally it should be below 0. Just like we had during the COVID-19 pandemic, then we had a massive rally to the upside, which is not the case right now. We are quite above 0. However, I don't see the real interest rate going further high. It seems to be quite stable. So I'm not going to consider this type of data to be either bullish or bearish, but actually cautious. This is the signal number 1. Signal number 2, it is the global liquidity, and as you have been following me long enough, the growth rate of the global liquidity. Since my last video, it seems like the M2 global liquidity just made a new all-time high, which is considered positive. And at the same time, the M2 growth rate, although it is trending down, it is still quite below what I consider to be a danger level, which is like 1 or 2, maybe 3. So although the growth rate is still going down, but it's quite above 3. So to me, this is quite bullish. And in addition to that, we can see that bank credit expansion is still trending up. We would be in a recession if the bank credit expansion was actually shrinking, not expanding. So taking that into account, we can say that the first signal is actually bullish. Signal number 1 is either 1, I will leave it this way, but signal number 3 is the total ETF inflow. And as you can see right here, since the beginning of the year, I still see a lot of inflow compared to some local outflows. In general, we are still having a lot of ETF inflow to Bitcoin. This means even more liquidity and more money coming into the Bitcoin market. So I believe that we had a short drop around this time right here, but as you can see right here, we are starting to catch up again, and I believe we are still going to consolidate a little bit before dropping even further and reaching the top. So to me, signal number 3 is actually bullish. Now, signal number 4, and to me this is one of the most important ones, is how the Fed looks at the economy. So pretty much the main job of the Fed is to keep economic growth. And as we can see, the current GDP is way above 0 at 3.4. So this is positive. It means that the main goal of the Fed is actually being accomplished. Positive economic growth. And then we are going to see their dual mandate regarding the labor market and the inflation. Inflation, although it is above 2, you can see that it is under control. There was a speculation that the tariffs were inflationary, but now they have enough data to support that tariffs are not inflationary. So from the Federal Reserve standpoint, inflation is under control, which means a positive economic outlook. And then lastly, we have the labor market. And it is tricky because right now we can see that unemployment rate is starting to rise. However, it has not spiked like the COVID-19 pandemic, for example. So the labor market is weakening, but it is not devastated. And that's an extremely incentive for the Fed to cut rates. So all the 3 checks right here confirm that the Fed job and their dual mandate is actually quite bullish. And all that data is confirming to me that this cut is going to be a normalization cut. Now, just because it's a normalization cut, I'm not saying that it's going to be immediately bullish. We had a couple of different scenarios for the first month. So let's take panic out of the way and recession. And when you take a look at normalization, the first month can actually be bearish, with some exception of a bullish month. It is not right here, but we also saw that in 2024, we also had a bullish September. But I believe that we may have a short dump still in September, and I'll tell you exactly why. The behavior that I see on the Bitcoin price is similar to what we had at the beginning of the year. After Trump's election in 2025, we had the Liberation Day in April, and the market had 2 dumps before continuing its way up. And yes, I am expecting a selling the news event that's going to happen later today, in which the price is going to dump further. And we may have maybe a little bit bearish September, but not too much. If not that further, maybe into this level right here, I think we are still going to dump before continuing to rise the prices. And what I expect to happen next is that we are going to have more cuts in 2025, but then we are going to start the bear market in 2026. And here's exactly why. I'm going to give credit to Mark Zandi here, as he's saying pretty much what I believe. There is an uncomfortably high 48% probability that the US economy will suffer a recession in the next 12 months. That's according to Moody's recently unveiling leading economic indicator derived using a machine learning algorithm on our extensive databases. It's less than 50%, but historically the probability has never gotten this high and a recession has not ensued. So yeah, I agree with him that we are already in a recession. Because, I mean, look at this. I even posted this on Twitter. We got a labor market revision of almost 1 million in 2024. This is the highest revision that we ever had. So yeah, just like I said, we are already in a recession. But they're only going to pay it back next year. But we still have some room to cover by the end of 2025. Let's see how the price is going to behave, but nonetheless, I still believe that 2026 is going to be a bear market. The 4-year cycle is not over. I think we are still going to have the 4-year cycle of Bitcoin is going to be bearish, and that's okay. So what do you guys think? Are we going to be bullish or bearish after the first rate cut? Let me know what you think in the comments. Thanks for watching. See you in the next video.